Hello, everyone, and welcome back to the GMS Weekly Podcast, where we break down the key developments shaping the global ship recycling markets.
It's week 26 of 2026, and this week's story is clear. Traffic doubles, but the yards still wait.
Exactly. The war is over, but the paperwork is still catching up with the peace.
The formal signing in Switzerland was delayed, right?
Yes. The signing at Bergenstock was postponed after Vice President Vance turned his plane around, with the White House citing unresolved logistical issues.
But on the water, things are already moving.
Very much so. The interim memorandum remains in effect, and implementation is accelerating through the Strait of Hormuz.
So the ceremony paused, but the shipping traffic did not.
Correct. Vessel traffic through Hormuz doubled in 24 hours, reaching the highest level since late February.
That is a big signal.
It is. At least 34 ships exited into the Gulf of Oman, compared with a pre-war daily average of about 110.
So still not fully normal, but clearly recovering.
Exactly. The direction is what matters. The strait is filling again.
And that is already changing the oil market.
Dramatically. Brent crude has fallen below $74 per barrel, its lowest level since before the war began.
That is a long way from the peak above $126.
It is. The war premium has almost completely disappeared. WTI is also below $70.
So the market has gone from fear of shortage to confidence in reopening.
Correct. Even though U.S. crude inventories are extremely tight, prices are focusing more on the return of Hormuz traffic.
That tells us how powerful the reopening narrative has become.
Exactly. For ship recycling, the key point is that lower oil removes one of the big reasons older vessels stayed trading.
The bunker cost support is gone.
Yes, and freight is cooling too.
The Baltic Dry Index has come down from the war peak.
Correct. It eased to around 2,634, down from over 3,200 at the start of June.
And Capesize earnings?
Around $35,800 per day now, well below the late May highs.
Still decent, but not war premium levels.
Exactly. The Capesize premium has unwound. The fuel side and the freight side are both normalizing together.
Which means older tonnage has less reason to keep trading.
Correct. And that is where the recycling story begins to shift.
We finally saw the first clear marker.
Yes. The Andhika Paramesti, a 9,369 LDT bulker, was sold to Bangladesh at $460 per LDT on an as-is Sambu basis.
One vessel does not make a wave.
No, but it does show the tide is turning.
The candidate pool is starting to release.
Exactly. The queue is beginning to form, but the yards cannot fully absorb it yet.
Because this is Ashura week.
Yes, and also the monsoon, so the subcontinent is dealing with holiday closures and seasonal beaching restrictions at the same time.
So two queues are building.
Right. One queue is cargo moving through a reopening Hormuz. The other is recycling candidates starting to move toward the subcontinent.
And both are being told to wait.
That is the story of the week. The strait fills, the queue builds, and the yards wait.
Let's move into the destinations, starting with Bangladesh.
Bangladesh remains very well positioned. The taka is still holding near the floor of its band, around 122.70 against the dollar.
That stability has been impressive.
It has. The taka held through the war, through the peace agreement, through oil volatility, and now through a stronger U.S. dollar.
What about local steel?
Steel moved higher this week, from around 65,000 taka per ton to around 67,000.
So Bangladesh has currency stability, stronger steel, and the first sale marker.
Exactly. Chattagram has the appetite, the letter of credit support, and the plot capacity.
But not the weather.
Correct. The monsoon remains the binding constraint. The demand is there. The financing is there. The ships are starting to appear, but the beaching calendar is still ruled by the sky.
So the wave is forming offshore.
And Chattagram is waiting for the weather window.
Moving to India, the rupee continues to recover.
Yes, the rupee firmed to around 94.30 against the dollar, a 6-week high.
Lower oil is clearly helping.
Very clearly. India imports more than 80% of its crude, so Brent below 74 is a major relief for the import bill.
But the stronger dollar is holding the rupee back.
Exactly. The dollar index has reached its highest level in more than a year, with U.S. inflation at a 3-year high and markets expecting a possible Fed rate hike by September.
So India gets support from oil but resistance from the dollar.
That is the balance. The rupee is improving, but it is not running freely.
What about Alang?
Steel softened into the 36,500 to 37,000 rupees per ton range.
India is still the lowest-priced subcontinent destination.
Correct. But structurally, Alang looks better than it did during the war. It has deep yard capacity, more than 110 valid statements of compliance, a recovering currency, and now a deflating bunker floor.
But again, the rains are in charge.
Yes, the reopening is improving the supply outlook. The monsoon is limiting the pace.
Now Pakistan?
Pakistan opens the post-war period with the strongest currency in the basin.
The rupee is around 278.10?
Correct, a fresh 2026 best, and it remains the only subcontinent currency to appreciate against the dollar across the war and after it.
Lower oil must be helping Pakistan too.
Absolutely. The oil import pressure that built during the conflict is now easing sharply.
But Gadani's special wartime advantage is fading.
More than fading. It is largely gone. The Gulf proximity premium made sense when Hormuz was closed and regional routing was disrupted.
But now Hormuz traffic is returning.
Exactly. As the strait normalizes, Gadani goes back to competing on price and compliance, not wartime geography.
Steel remains firm, though.
Yes, local steel is still around 195,000 rupees per ton, keeping Gadani at the firmest absolute pricing in the basin.
So Pakistan is strong, but the game has changed.
Precisely. Pakistan won the war quarter. The peace quarter will be a different contest.
Finally, Turkey.
Turkey remains the outlier. The lira weakened again, moving past 46 toward 46.40 against the dollar.
Even with oil falling.
Yes, lower oil helps Turkey at the margin, but the lira's weakness is mainly domestic and structural.
Inflation is still the big problem.
Correct. May inflation remains above 32% and policy remains very tight. Cheaper oil reduces the pressure, but it does not solve the inflation structure.
And Aliaga?
Aliaga remains a niche market. Prices are around $266 to $288 per LDT, far below the subcontinent.
So mainstream tonnage will still move mainly toward Bangladesh, Pakistan, and India.
Yes, Turkey's role remains tied to EU regulation and Basel Convention compliance, not price competition.
So Aliaga's position is almost unchanged.
Exactly. The war changed many things in the basin, but not Turkey's basic role.
Let's wrap it up.
Week 26 is a transition week. The formal signing was delayed, but the water is already moving.
Hormuz traffic doubled.
Oil fell below $74.
Freight continued to normalize.
The first recycling sale marker appeared.
And the candidate queue is beginning to form.
But Ashura and the monsoon mean the yards still wait.
Bangladesh has demand and financing.
India has recovery and capacity.
Pakistan has the strongest currency, but its wartime premium is gone.
And Turkey remains a regulated niche market.
The strait fills.
The queue builds.
The yards wait.
That is the story of week 26.
The war that would not end has ended.
And the season that always ends has not.
That's all for this week's update on the global ship recycling markets.
We'll be back next week with more insights.
If you would like to get the complete market update delivered to your inbox, subscribe to GMS Weekly through the GMS website.
Until then, stay safe.
And thank you for listening.